right, here we are. This is the last lecture before our test, correct? So we're gonna have today's lecture, and then after today, you take the third test, which is over chapters 5 and 6, right? So before the period is over, we'll talk a little bit as far as some things that you can expect will be on there, okay? But first, let's go through the homework, all right? Let's go through Quick Study 6-9. I wanted you to read about 6 or 7 pages. I had a couple quick studies and an exercise for you. So let's go ahead and take a look at Quick Study 6-9. Okay, I'm a very visual learner. Maybe you are too. So I always have to write things down. One thing that kind of helps me, and if it doesn't help you, then just by all means ignore this. But let's take a look at Quick Study 6-9. Identify the inventory costing method best described by each of the following separate statements. Assume a period of increasing costs. Okay? You with me? Inflationary costs are going up. So how would that look graphically? Well, if this is costs, and this is time, then this would be the earlier costs, and this would be the later costs, correct? And over time, prices are going up, correct? So let's look at these. We'll come back to that graph in a second. Okay, what is the preferred method when each unit of product has unique features that markedly affect cost? The specific ID method. You don't need the graph for that one. Okay, but the specific ID method. Okay, that would be like a car lot or maybe a jeweler. Number 2 on Quick Study 6-9. Matches recent costs against net sales. All right. Let's do this. Let's go back to that. And actually what I'm going to do real quick is I'm going to write this again. Now, costs are going up over time. Is that correct? On this example? Yes. Okay. So, if we are looking at, let's just do this before we go through any further of them. If we are doing FIFO, first in, first out, that means the earlier ones are cost of goods sold, right? And the later ones are ending inventory, still in ending inventory. First in, first out, last in, still here, correct? Now with LIFO, it's the opposite. The last in, the later ones are the first ones out the door through cost of goods sold, and the earlier, lower priced ones are in ending inventory. Do you understand those two graphs? To me, that kind of helps as we think through these. Okay, let's look at number 2 again on Quick Study 6-9. Matches recent costs against net sales. Okay, well, which one of these matches the most recent costs, the later cost against net sales? LIFO, through cost of goods sold. Right? So number 2 is LIFO. Number 3, provides a tax advantage to a corporation when costs are rising. Okay, well, I know the answer to this because we were specific on it. Which one? LIFO. Look at our graphs. Which of these is going to have a higher cost of goods sold? LIFO. So a higher cost of goods sold, since it's subtracted from revenues, it will give us a lower net income before taxes, and thus a lower tax liability or tax payment. Okay? Okay, number 4. Yields a balance sheet inventory often let me read that again. Yields a balance sheet inventory amount often markedly less than its replacement cost. So it's saying yields a lower balance sheet inventory amount. Well, which one of these would have a lower ending inventory? Do you see what would be LIFO? Because the ending inventory would be those lower costs. Again, in this example, they're assuming rising costs. But the answer to number 4 is LIFO as well. So the answers to 2, 3, and 4 were all LIFO. Okay, number 5 on Quick Study 6-9. It's Monday morning. I can't talk very well. Okay? Need my coffee. Results in a balance sheet inventory amount approximating replacement cost. Okay, so that means that ending inventory would be recent costs, more recent costs. Look at our graphs. Which one of these does that fall in with? FIFO. Because the ending inventory would be the later, most recent costs. And that certainly would be a approximate replacement costs. It's a lot more than these, right? This ending inventory is way early costs. So number 5 is FIFO. Okay, any questions on that? Do those graphs help or hurt when you think through it? Okay. There wasn't one asked where the answer was weighted average. Maybe a good question where the answer would be weighted average is, which method smooths over price increases? Smooths them out. Because that's kind of what weighted average does, right? Okay? All right. Now remember, those graphs that I just showed you are only for a period of rising costs, which is the normal case. Okay? All right. Any questions on that? Okay. Now the next thing I wanted you to do was Quick Study 612. Is that correct? Now, before we do that, I want to show you something here. Okay? I want to show you something from the Dave Krug collection. Okay? Now, this is something I purchased in about 11 years ago. Okay? About 11 years ago, in maybe year 2000. But has anybody ever seen one of these? You can focus in on that as a. Have you ever seen one of these? This is called a Sony Watchman. Okay. Now I'm turning it on. It's not going to get a signal, and it's looking for a signal right now. But what this is a little portable. Put some batteries in there, and you could watch a little black and white TV, portable. Okay? Now, I thought this was the coolest thing in the world, and I can remember when I bought this. My wife and I had to go to St. Louis for a wedding, and we had to leave Friday at about dinner time, about supper time. And it was during March Madness basketball. And I was like, I'm going to miss all the basketball games. So if we got to be there Saturday morning and we have to work till 5, and it's like, oh. So I thought, I know what I'll do. And I went, I'd seen these wonderful nifty things advertised, and I bought this. And my wife drove to St. Louis, and I sat in the passenger side. And I had the game on the radio so I could hear, and I watched this little black and white screen, and I watched the whole game. And I just thought it was the most wonderful thing in the world. Okay? Now, that seems pretty primitive now, doesn't it? Okay? I mean, I have a phone right now that I can watch TV on, and it's color, right? This is, people buying much of these anymore? No, they aren't. Now, do you know what I paid for this? No. I paid about, the selling price was $125, okay? The selling price was $125 of that, okay? Now, I bought this at Circuit City, okay? And I have no idea what the cost of this was to Circuit City when they bought it from Sony. Okay? I have no idea. I'm just going to guess. Let's say the cost of goods sold was $40. Okay? So if that was the case, I know the selling price was $125. I know that, and the cost of goods sold, let's assume, was $40. Then they made $85 gross profit on that for Dave Krug's purchase, right? Okay. Now, why do I explain all this? Well, generally speaking, merchandisers have a lot of inventory, right? Which value is higher, their sales price or their cost of that item? The sales price. Because if their sales price isn't higher than the cost that they bought it from the manufacturer, they're not going to be in business very long, is it? So we generally value inventory at cost because almost always the cost is lower than the selling price. Agreed? However, what do we do in that rare case? What do we do in that rare case if the selling price goes below the cost? Because once you pay for something, the cost is set. The cost can't fluctuate for inventory items that you already have, correct? But the selling price can go down. Okay? Said another way, let's say that Circuit City was doing inventory all these years later, and guess what they found in a corner of their warehouse, in a retail store, a corner of their showroom? They found 100 units of one of these, a Sony Watchman. Okay? Now, they have 100 units, and what are those on? Those units are on the books for that retailer at what cost per unit? $40. And so they have an asset on the books of $4,000 in inventory, correct? Would you agree? Now let me ask you folks. If that retailer has 100 of these items, do you really think that those are worth a total of $4,000, $40 each? No, they are not. So at this point, this would be a rare case where the selling price has no doubt dropped below the cost. And this asset is now overstated on their books. You with me? What do you think you could sell these for?
25. I think you could.
Maybe some nostalgic people my age might buy them. But you're not going to get 125 for them. I don't think you're going to get 45 for them. Maybe what? 10 bucks maybe. Maybe 10 bucks. Okay? So what they would have to do in this case, this was the cost. What they would have to do, this is the market value now, MV. And if that went down to 10 bucks per unit, they would have to write that inventory down to $1,000 on their books. In other words, they need to do the lower of cost or market. Now, usually, almost always, the lower of cost or market is going to be cost, right? Because that's how they make money, is to mark it up and have the market value be more. But in the rare case, going back to the Elmo, in the rare case where the selling price has dropped tremendously and the market value is only 10 bucks and it's below cost, well, what's the lower of these? Is the lower 4,000 or is the lower 1,000? It's 1,000, and you have to write this down to the lower of cost or market. Jake.
Is that considered an adjusting entry?
Is that considered an adjusting entry? Yeah, I think it would be. I think you would periodically want to look at your inventory and see if this were your situation, and it probably would be done at the same time as all your adjusting journal entries. That's a good question. Okay. Any other questions on that?
And so when you adjust it, what do you write down in your books for that other 3,000?
That's what you write down.
Pardon me?
Don't you write, what do? You credit merchandise inventory for the difference.
Yeah.
And debit cost of goods sold.
Yeah, and there's, you might debit cost of goods sold for that. I mean, let's just do that journal entry. Going back to the Elmo. Uh-oh. There we go. Okay. I'll have to write it in here small. Here you are exactly right, Jake. We would have to credit merchandise inventory for $3,000, okay? And what would we debit? More than likely you would debit cost of goods sold, even though it wasn't really sold. It would be kind of like the inventory shrinkage, remember that? Where you kind of considered a cost of doing business. Okay, good questions. All right. Now, in your slides, they gave you an example here, right? Now, what they have here is the given information that they usually provide is this info right here. They give you the inventory items, the units on hand, and the per unit cost and the per unit market. Now, the first thing that you need to do is these two columns right here, is do the total cost times the total market. So 20 times 8,000 equals 160,000. 20 times 7,000 equals 140,000. 10 times 5,000 equals 50,000. 10 times 6,000 equals 60,000, and so on. These are kind of high-priced items, aren't they? So the first thing that you have to do is get your total cost and your total market. You with me? Now, once you do that, let's take those last two columns forward. You can either apply LCM to each item, or to a category, or to the whole. If you do it by item, then you go through each item and say, okay, what is the lower of these two numbers, 160 and 140? It's 140. What's the lower of 50 or 60? It's 50. What's the lower of 40 or 52? It's 40. What's the lower of 45 or 35? It's 35. Thus, I would write my inventory to a total of 265. That's if we applied LCM to each item. You with me? Now, if you did it just to categories, you would just say, okay, let's look at our category subtotals. What's the lower of 210 or 200? 200. What's the lowest of 85 or 87? 85. So I would write my inventory down to 285 if I was doing it by categories. Or you could do it as a whole. What's the lower cost or market if I'm just looking at the whole? 295 or 287? 287. Okay? You with me? All right. Now, I gave you a quick study to do on that, didn't I? Did you have trouble with that? Okay, let's take a look at it. Okay, quick study 612. Tailspin Trading Company has the following products in its ending inventory. Compute lower of cost or market for inventory applied separately to each product. Okay? All right, well, they give us, let's show what they give us. All right. This is what they give us in the middle of your screen. Okay? They give us the inventory items, They give us the units on hand, and then they give us the per unit cost and the per unit market, right? Is that what they gave you? Okay, what's the first thing we have to do? Right, we have to multiply those out and get our total cost and our total market. Right? You with me? Whoops, I need to back up a little more. Okay? Now, once we do that, they tell us to apply LCM to each product, right? So, LCM to each product. Okay, well, which one of these is lower, 3240 or 2970? 2970. Which one of these is lower, 2520 or 3240? 2520. Which one of these is lower, 12,000 or 10,500? 10,500, okay? And you can see that you can see that written a little cleaner right there, right? And so they would write their inventory to 15,990, okay? Does that make sense? Okay. In the lower of cost or market, you might think, why do we always have to look at worst case scenario? Well, it's one of the things that we do in the conservatism approach. We want to be conservative. We don't want to overstate our assets. We don't want to give people a better picture than what is actually reality. Okay? Like I said, most of the time, the lower of cost or market is the cost. But in the rare times when market drops below, we have to make these adjustments. Kara.
So on that, the skateboards technically is the only one that made any profit. Is that what it says?
Yeah, they're not doing real well, are they? Okay. Now, what she's pointing out is, if you look back at the original data, the skateboards are the only one where the cost is lower than the market. So I'm not sure what's happening in that situation. Of course, they created an example that would work well to teach this concept. But, yeah, that's the case.
Okay.
That's the case. I hope they sell a lot of skateboards, huh? Okay. All right. And you have to also remember, too, that maybe they're continuing to purchase items and the costs have gone down. This is the cost of items that are actually in their inventory now. Okay? All right, any questions on that? Okay. I'm trying to think if we might have enough time to do something else. And I don't think I'm going to do one. I think that's the best example for you to study for your test. Okay? There'll probably be like maybe one multiple choice over lower of cost or market. Okay? All right, is that fair? Okay. All right, the next thing I want to do is I wanted you to read about the ratio at the end of this chapter, and that was in regards to inventory turnover. Okay? Inventory turnover and days sales in inventory. What is inventory turnover? Well, as you read, hopefully, it shows how many times a company turns over its inventory during a period. Okay? Indicates how well they're controlling the amount of inventory available. We calculate it by taking cost of goods sold divided by average inventory. You with me? And then how do we figure average inventory? We just take the inventory at the beginning of the period plus the inventory at the ending of the period and divide by 2. That's inventory turnover. Related to that is days sales in inventory. This is how much inventory is available in terms of the number of days sales. Okay? Now let's talk about inventory a little bit. Okay? Let's talk about inventory a little bit. Okay, inventory. I have experience going into companies and looking at their inventory and analyzing their inventory. Okay? A lot of my clients, they sell inventory to make money. You with me? Now, and I still do that on a consulting basis. Inventory and how it's flowing and those sort of things is a very, very important measurement. Okay? Does anybody here, has anybody here ever worked as a server in a restaurant? Anybody? You have? Kim? Where'd you work?
Pisano's.
Where?
Pisano's.
Pisano's. Johnny's. Okay. So you were both, they don't call them waitresses or waiters anymore, do they? It's servers. Is that correct? Okay. So you would have a certain section of tables, and you would wait on them and provide them their food, and they'd leave you a tip, and hopefully, right? Okay. Are people good tippers? No. What's a good tip? 15%?
Yeah, 20.
Okay, 20. Okay. All right. Let me ask you this, ladies, for those of you who are servers. Did you ever have a table, like let's say you worked a 6-hour shift, and you know that every time somebody comes in, eats, pays, leaves a tip, then you get that money for tip, right? Do you have anybody come in, eat, pay, and they just sit there? And they sit there and visit about their lives. Literally for an hour or two? Have you ever had that happen?
Especially at the end of the night.
Especially at the end of the night, okay? Does that drive you crazy? Why does it drive you crazy?
Because I want to leave.
Because you want to leave, but also
Get a new.
you want to get a new, you want the table to turn over. Is that right, Kim? You want these people to leave, and the new people come in and do the whole process again and get another tip, right? Well, you can think of that a little bit as we think about inventory. And we talk about turnover, and in things like football or basketball, turnovers are not good things, right? It means you blew it. The other team got the ball. But when we're talking inventory or serving in a restaurant, you want there to be good turnover. You with me? That being said, it's going to seem like I'm switching subjects right now, but I'm not. Have you guys read about this financial crisis that's happening in the world? Yeah. Okay. And all these banks have made commercial loans. Well, a lot of banks have made commercial loans. And when you make a loan as a banker, anybody here work at a bank? Okay. When you make a loan as a commercial banker, you're hoping that eventually it will be repaid. That's not too difficult a concept, is it? Right? You want your loans to be repaid, the principal and some interest. Well, so what do you think the first sign is in normal cases for a bank or a lender that one of their borrowers is in trouble? What do you think the incident that causes them to say, I think our borrower is having a difficult time?
Late payment.
A late payment or no payment. That's when they find out that their borrower is not doing well, because it's like, ABC company has not paid us in a month, have they? Okay, right? You with me? Well, that's not the best way to realize that your borrower is in trouble. And what I have realized in doing some consulting is a lot of these lenders simply don't understand accounting very well. They don't know how to read financial statements. Okay? And I'm going to tie all this together. It seems like I'm jumping around, but I'm going to tie it together. One way for you all to know that Dave Krug has a bad heart, if I had a massive heart attack on camera and fell down, right? That might make it to YouTube, right? Okay? But if I had a massive heart attack, fell down, and they had to call an ambulance, somebody I hopefully would call an ambulance, right? Okay? And they came in and got me, and they took me, and I survived, and everything was okay. That's one way to know that I have a bad heart, correct? But isn't a much better way if I went to the doctor and they did some tests or I did a treadmill evaluation? Isn't that a much better way? Not to wait until it's that bad, I have a massive heart attack, okay? Well, a much better way for a commercial lender to realize that their borrowers are in trouble is if they can correctly analyze financial statements. And I found that they're not very good at doing this. What they'll do is they'll request the financial statement from the company, and they'll look at it, looks good, and they'll put it in a folder. And then the next year or the next month or the next quarter, depending on how regularly they require, they'll look at them, put them in a folder. But what they're not seeing is that things are getting worse. Sometimes gradually, sometimes not so gradually. And they might even be continuing to loan money. Okay? Continuing to loan money to this customer because they're not seeing the trend, the negative trend that is occurring. Following me? One of the key measurements that bad things are starting to happen is inventory turnover. When we go into a client that has all of a sudden stopped paying their loan payments, and a lot of times banks will pay the consulting company that I work for sometimes to go look at this. But when we go do this, we can look back at the last year and a half, 2 years, and we can see their inventory turnover slowing down, slowing down, slowing down. Do you see how a slowing down inventory turnover is not a good thing? And how eventually it's going to result in cash flow problems? And we're always like, I wish they would have called us in to help this company a year and a half ago, because we could have done so much more good. Or maybe the bank has even continued to make loans to this company over the last year and a half because they weren't measuring the trend. Does this make sense? Are you guys following me here? So these aren't just fun and nifty little ratios that we can compute. These are ways we can assess the health of a company. And as a manager of a company or as a lender or potential lender to these companies, we should be very invested in knowing what the health of a company is and if it's getting worse. Are you with me? But a lot of lenders just don't understand this. They want to make loans, and they make loans, and then they're being defaulted on. And we can read in the papers where there's millions, tens of millions, if not hundreds, of loans that should have never been made. You see what I'm saying? Okay. So, looking at this ratio, inventory turnover. You calculate your inventory turnover. You want to trend this over time. Now, you do not want to have inventory is a tricky thing. You don't want to have too much inventory. Why? Because there's costs of inventory. You have to store it. You have to have a security guard maybe guard it. You have to have space to put it. You run the risk of it breaking or being stolen. And what else do you risk if you have lots of inventory? Damage, but you also risk that something's going to happen to it, like this guy. What if there was some astute retailer who said these are going to be the hot item and they purchased a ton of these? You see that how they're in worse shape if they have a lot of inventory? Okay. So you don't want to have so much inventory where the costs go up, but you don't want to run out of inventory either. Are you with me? As a retailer, it's got to be very frustrating. You ever go into a bookstore and you say, hey, do you have this new book? And you tell them the author and they go, we're out. We can order it for you and it'll be here in a week. And you're like, or I could just go across the street and buy it over there, right? So you don't want to run out of inventory and you don't want to have too much inventory. But the inventory you have, you want to turn over. You see what I'm saying? We're talking about retailers, so some of these concepts, this is kind of the first time that these are pertinent. Are you guys following me? Okay. So, some things to think about. And we could talk about this, a long time, and we won't. This is just going to be kind of a brief introduction to this concept. But I want you to look at exercise 610, which I wanted you to read about and do. Use the following information for Ryder Company to compute inventory turnover for 011 and 010 and its days sales and inventory. Round answers to 1 decimal. I usually like to do 2 decimals, but okay, we'll do it to 1 decimal. Comment on their efficiency in using its assets. Okay? All right, let's take a look at that. Did you guys compute these? Okay. Let me put the answers up there. And just leave those up there if you would. Did you get 74.2 days for 2010 and 54.7 days for 2011? Did you guys get that? Okay. So in 2010, their inventory turned over 4.8 times versus 7.0 times in 2011. So is that good or bad? We're happy, aren't we? Things seem to be getting better. Now our days sales in inventory is also decreasing. Okay? That means we have if we stopped buying, we would have enough inventory to last 54.7 days worth of sales in 2011. Okay? Now you don't want that number to get too small, right? You don't want customers coming in wanting to buy something and you're out of it. Okay? But looking back at that, 2010, the inventory turnover improved between 2010 and 2011, and we can see that the days sales and inventory is decreasing. Okay, so I think they're being somewhat efficient. Now, we don't really have a whole lot of info to trend, or we don't have competitor analysis, but this is kind of a nice little exercise, at least to practice calculating those. You with me? All right, questions on that? Okay, good. All right, let's talk about the last couple of things. I think that's it for the homework. I want to go back to this slide right here. Now, do you remember me talking about how we value inventory is very, very important, not only for the balance sheet, but also for the income statement, correct? Because what we value our inventory at will also affect our cost of goods sold, which is on the income statement, correct? So what happens if we make a mistake and we understate our ending inventory? Or we overstate our ending inventory or something like that? Well, I want you to realize that there's going to be errors that kind of flow through all the financial statements, okay? And I always can see that best when I look back at those 2 equations that we learned at the very beginning of this section, and 2 equations that you really need to know, okay? And that is this one. Beginning inventory plus purchases equals merchandise available for sale. Less ending inventory equals cost of goods sold, right? And we also know that sales minus cost of goods sold equals gross profit minus operating expenses equals net income. Remember those 2 equations? Now you need to know those for the test. Okay? I want you to see something here. Do you see how if you incorrectly counted your inventory, and if ending inventory was too high, falsely too high, do you see where cost of goods sold would be falsely too low? Do you see that? And if cost of goods sold is falsely too low up there, it's also falsely too low down here, isn't it? Which would make gross profit falsely too high, correct? Whenever there's a negative sign, the arrow switches sides. So if your gross profit is falsely too high or overstated, then your net income is overstated. Are you with me? Does that make sense? Now, let's say that red is year one, okay? Red is year one, and let's say that black equals year two. Okay, well, if year one's ending inventory is overstated, do you see where year two's beginning inventory would be overstated? Do you see that? So in year two, the beginning inventory would be overstated, which would make merchandise available for sale overstated, which would make cost of goods sold overstated as well. If cost of goods sold is overstated, then gross profit would be falsely too low or understated, as would net income. Now, there's a couple things, and leave it up there if you would. There's a couple things that I want you to realize in this analysis. Actually, let's say three things. First thing is you need to know these equations really well because you use them all the time. The second thing is if you make a mistake and like you overestimate incorrectly your ending inventory, it affects the balance sheet, it affects the income statement, affects everything. The good news is if you make an error, it does what we call self-corrects itself after 2 years. Do you see how the cost of goods sold is offset here? How the net income effect is offset? Eventually, if you make an error, then it will self-correct itself after 2 years. It doesn't continue as a mistake for perpetuity. Okay? You with me? Now, going back to the slides, that's kind of what this is talking about. I don't do real good when it's just like memorizing something like this, but you can see the same thing. You can compare this to the analysis we just did. If ending inventory, well, which was the one we did? Ending inventory overstated? Okay. Let's look back. I can't remember. Ending inventory was overstated. Okay. Well, if ending inventory was overstated, well, sure enough, we saw that cost of goods sold was understated and net income was overstated. Isn't that what we saw? Okay. And they follow you through the other things like that. And they, and then they take you through this as well as far as what's the effect on the balance sheet as far as assets and equity. Okay. I personally think as opposed to memorizing this chart, it's easier just to look at this analysis right here. Do you understand what I'm saying? But I usually have a multiple choice question that asks you if ending inventory or beginning inventory is overstated or understated, then the effects of blank are blank, right? You with me? So you might know that for the test. Okay? Jake, do me a favor. Pass one of these out to everybody if you would. And hand me back what doesn't get handed out. Let's talk a little bit about what's going to be on the test. I'm giving you all who are face-to-face one of these, but just leave it up there if you would, camera guys. Now, these are things I guarantee you will be on the test. From Chapter 5, I guarantee you need to know those equations that we just went through. The inventory flow equations, the net income equations. Remember the quiz we had on that where I gave you some numbers? Look over that quiz, and you had to calculate those amounts. Okay? I guarantee you're going to have to do journal entries for both the purchaser and for the sales. Or let me say that again a different way. For a merchandiser, I think I have a mistake here. Sorry about that. You need to be able to just say you need to know the journal entries for the purchase cycle and the journal entries for the sales cycle. I think that should be merchandiser as well, although it's the same either way. Okay? But suffice it to say, You need to be able to do the journal entries for the purchase cycle and for the sales cycle. This is like exercise 5.2. This is like the quiz that you all took last time. Did I hand that back to y'all? Before you leave, I'll hand it back to you. Okay? I have yours graded, and I'll give them back to you, face-to-facers. You need to know the acid test ratio and how it compares to the current ratio as well as the gross margin ratio. None of this should be a surprise, right? Okay? Once again on Chapter 5, make sure your brain is shifted into the right gear. Am I doing JEs for the purchasing side, or am I doing the JEs for the sales side? Okay? And once again, that is a section where people think they understand it and they don't. Some of you didn't do well on that quiz. And you probably thought you were going to, but when you have a blank piece of paper staring you in the face, then you realize, I don't think I know these accounts like I thought I did. They're all kind of jumbled up in my brain. Best way to study for my test is to redo your homework with a blank piece of paper. Chapter 6, you need to know the definitions and such regarding inventory, those first few quick studies that we did. You need to be able to calculate cost of goods sold and ending inventory using FIFO, LIFO, weighted average, and specific ID. And I will provide you inventory sheets on the back of your test if you want to use those. But as another reminder, guys, I am only judging you on if you got the answer right. So if you make a silly little math error or something, you're going to miss all those points. I'm not going to look through each person's individual inventory sheets. I'm simply going to look to see if you have the right number in the blank. You all understand? Okay. What are the advantages and disadvantages of the above methods? We kind of talked about that today a little bit. And then I want you to know LCM as well. You with me? Okay. And you know, you might look a little bit over those two inventory ratios as well. At most, I might have one multiple choice on the inventory turnover and then the day sales. Okay. Now, once again, there's a really good practice test for chapters 5 and 6, and the answers are on there as well, correct? That has some really good problems. If you cannot do the problems on the practice test, you cannot do the problems on the test. Okay, has anybody looked at that already? Okay, good. All right, any other questions? All right, good luck on the test for you people at home or you people watching this on a media or online class. Be real careful as far as when the due date is to have taken the test by. Good luck. When we come back, we do not go over Chapter 7 in this class. So we will start Chapter 8. It's not up there, but it'll be on there soon. It'll be up there. I'll put it up there today or next day. Okay? For you folks at home, it'll be up there. Okay? We'll see you guys later. Bye.